We all want some level of safety and security. Firefighters, construction workers, EMT. They're all there when you need them to help manage life's chaos. In retirement, you want that same level of safety, but who is there for you to make sure your money will last? Brian isn't just there in case of emergency. He's there so you don't have an emergency with your money. A safer retirement doesn't mean a boring retirement, but a prepared one, full of the things that inspire you. This is Safer Retirement Radio with Brian J. Decker.
Welcome to Safer Retirement Radio with Brian J. Decker of Decker Retirement Planning. I'm Mark Elliott. Glad you're with us today. You can always find out more about Brian and the team by going to the website deckerretirementplanning.com, deckerretirementplanning.com. And I start the show every time by saying on that website, deckerretirementplanning.com, there's a heading of Safer Retirement Education. There's 12 different things you can download. There's a sample income plan. There's a checklist challenge. There's a Principles of Retirement book. There's also Brian's book on retirement, The Decker Approach. That's just 4 of the 12 things you can download. All that information is just there for you. It's just for your information. You have questions, you can always call the team with questions. But it's a way for you to do kind of your own research into retirement. 833-707-3030 if you want to chat with the team, have any questions or concerns. Do I have enough? Are we going to be okay? 833-707-3030. Today, joined by Arrin Wray of Decker Retirement as well. So Arrin and Brian going to handle the duties of radio today. And Brian, where are you going today? What's the topic? We're going to talk a little politics? So are you going to go break down Democratic and Republican parties today?
No, we're going to talk about geopolitical risks, economic risks, a lot of uncertainty right now in the markets, and the markets do not like uncertainty. Markets are a little rattled with the uncertainty of the Trump tariffs, concern about inflation, rising prices, consumers maybe not paying. There's a lot of uncertainty there. And in fact, for all retirees, we want to make sure that they are ready for the uncertainties. Just on the geopolitical agenda, Mark and Arrin, there's U.S.-China tensions. There's Russia and NATO confrontation. Maybe that Trump solves or doesn't solve the Russian conflict in Ukraine. There's Middle East instability. There's cyber warfare and AI. When an AI arms race, there's a global supply chain potential disruption. There's climate change and resource conflicts. I'll just throw out a couple more. The list is pretty long. There's political polarization and democratic backsliding going on in our country. There's nuclear proliferation and rogue states like North Korea and Iran. So anyhow, that's just the start of a list here. Is your plan able to handle all of that potential conflict, problems, uncertainty if things were to go south on any one of those, much less 3 or 4 of those? So Arrin, in building the plan, now we've got radio listeners, not TVs, so we can't show them the plan, but talk to retirees about how the plan is different. Accumulation strategies versus distribution strategies. Let's start there, and why the accumulation strategies that get you to retirement are definitely not the strategies to work in retirement. Let's start there, and then we'll delve into the details of how the distribution planning protects you in retirement from these uncertainties.
Yeah, absolutely. So this is one of the core differences that kind of sets us apart as a advisory firm to begin with, where a lot of advisors that listeners may go speak with are going to have people that they work with that are 20 years old to 100 years old and kind of anybody in between. Decker Retirement Planning is a little more niche in the sense that we only work with clients that are in or about to be in retirement. And so what we do from a mindset standpoint with our clients is help them shift from those earning and saving years into the distribution years, which is more about protection, still growth, but more utilization of the funds than it was before. So during your working career, the goal for saving and investing is really just to see your asset base go up. You want to see those accounts, the real estate values, the assets, the pension numbers, whatever it is that's going to supply you with income or funds in retirement, you want to see those numbers increase in value. Now, when you do stop working, and actually shift into retirement, there's a couple of things that shift. And one of them is the mindset around your funds or the purpose for those funds that you've built up. So like I mentioned, accumulation is more about just seeing those numbers go up. The distribution phase is, okay, we've stopped working. We've stopped adding to these accounts for the most part. Now it's time to see how we can make use of them. And so that brings in a lot of different things that weren't necessarily applicable before, right? You don't have to worry about income distributions. You didn't have to worry about taxes in the same way. You didn't have to worry about some of the way that the investments were structured or the withdrawals out of the accounts. And so the distribution phase is fundamentally different from the accumulation phase in the purpose that you have assigned to the funds. So anything that you'd add to that so far, Brian?
Yeah, I like to say it a little differently. I like to say, in your 20s, 30s, 40s, 50s, if the S&P markets go down 30, 40, 50%, no big deal because your income is coming from work. And every 2 weeks, you're kicking money into your 401k. You have the time, the 3 to 5 years for the markets to recover. You actually benefit from that market drop because you're kicking money into your 401k in a down market. And when it recovers, you're better off for it. But in your 65 plus years, the portfolio that's producing income, when that drops 30, 40, 50%, and you're pulling money from it, that is different. That's terminal. That sends you back to work. So what we do is we use distribution strategies to make sure that clients keep, actually several things go on at the same time. 6 things. 1, you have a plan. Most people don't have a plan. Its pie chart is not a plan. Most people think that a pie chart, they're supposed to figure out how much income they can draw from that for the rest of their lives. No wonder, Arrin, that the number one fear is running out of money before you die for people in the US over 65 years old.
Yep.
And so number 1, we have a plan. Number 2 is tax minimization strategies. That's part of distribution planning. We've done a whole show on that. Number 3 is risk reduction. I think that's what we're going to focus on here today. There's 3 parts to it. Strategically lowering your risk. We'll dive into that. Number 2, quantitatively lowering client risk. And number 3, eliminating interest rate risk. We'll talk about all 3 in detail in a minute. And then number 4 is portfolio optimization, making sure if we're a math-based firm and we're fiduciaries to our client, we do the homework to make sure that every part of a client's portfolio is optimized and returns are optimized, net of fee returns. And then number 5 is income. Number 1 focus for us as retirement planners is optimizing their net of tax, their after-tax monthly income. And then number 6 is fee minimization. Fee minimization. Most people pay over 1% on their total fees on their portfolio. People over 60 in the United States, it's a data point you can research and look up. For our clients, they pay about 70% less on average. And so that's something important. But those 6 key things are part of distribution planning. But we threw out at the top of the show, Arrin, a bunch of potential problems, geopolitical problems that could change people's lives in their retirement. So talk to us. Let's talk about the portfolio side. Talk to us about distribution planning and go into detail. This is going to be probably the rest of the segment. Go into detail about, in general, how principal guaranteed accounts work, the 4 key reasons we use them, and then dive into how the risk strategies work together with that too.
Yeah, this is actually one of my favorite things to describe to clients because not only is the concept new for most of the people that we work with, it's also fundamental to helping you have that peace of mind in retirement, where most people at age 70, 80, when you're well into your retirement years, at that point in time, you're not interested in having to just glue yourself to the news or to the markets or to your computer monitor to make sure that your portfolio is not going to take a massive hit on any given day, week, or month. Most people at that point want to have the surety that they are invested the way that they should be, that they have the correct protection mechanisms in place so that they can go do what they want. You can travel, you can visit your family or your grandkids, you can go do those hobbies and those things that you want to spend your time doing. You don't want to worry if any of the umpteen things that you listed off, Brian, if there's any geopolitical tensions, if things in the country take a turn for whatever reason, if the economy starts to go down, you as a retiree don't want to worry that that's going to dramatically impact your portfolio, which in turn would negatively impact your day-to-day spending. So one of the fundamental things that we do is help you have the appropriate investment strategies, the appropriate level of risk relative to your goals, the income that you're taking, some of the other variables that we discuss to give you that comfort and that peace of mind that you're looking for. So fundamentally, we help you restructure the investments in your portfolio to have a more protected approach. You don't, when you're in retirement, want to have 90 to 100% of your assets at risk anymore. That was for the accumulation years when, like you described, Brian, you're 30, 40, market can take a nosedive. It actually works out in your favor because you're adding to that account and you have a long enough time horizon to recover. So we typically put in between 60 and 70% of a typical client's assets into what we call principal guaranteed accounts to help you have that protection and that surety. So if there's major things that impact the market, geopolitical concerns, you, with that plan in place, don't have to worry that that's going to dramatically cut your income. If you're spending $10,000 or $12,000 a month, all of a sudden your portfolio halves, and now you're like, oh, we can only spend $5,000 or $6,000 until this recovers. Probably not your ideal retirement scenario. So when we put those principal guaranteed accounts into place, the goal for those vehicles is to, number one, protect the funds. These types of investment vehicles can't lose money. You can't have a negative return, so that when there are market fluctuations or big drops, which is inevitable at some point in time in the future, again, you have that comfort that you're going to be able to have the income that you need. So the way that these work is we like to ladder them out to make sure that you have the money needed at the point in time that you're looking to spend it. Because when you retire, you're going to need some money right away. You're going to need some in 2 years, 5 years, 10 years, 20 years. And so we want to make sure that these are structured to not only protect the funds that are sitting there, but also to make sure that you're getting the highest rate of return on those and you have the money readily available when you need to spend it. And so our goal is to really nail down mathematically the numbers, the percentages, the dollar figures that need to go into each of those accounts to make sure that you have the appropriate structure put in place. So having a plan to begin with is one of the major things that we help with, where it's not just hey, we're going to put a little bit here or $100,000 here and just hope for the best. We have rationale and explicit reasoning behind the way that we do things. And we have a lot of data, a lot of experience, a lot of time doing this to back up the decisions and the recommendations that we provide for you. So there's a lot behind that. Brian, what would you add so far before we continue?
Okay, I'm going to go into detail on the 4 key reasons that we have clients drawing laddered principal guaranteed accounts. The first is math-based, that when you draw income from a fluctuating account, you compromise gains when markets go up, you accentuate losses when markets go down. That's what happens when you draw from a fluctuating account like a pie chart. And it works until it doesn't. And when it doesn't work, that's very inconvenient. It usually sends you back to work. But the first item is really peace of mind. When you draw income from principal guaranteed accounts, 2022 was classic. S&P down 19, NAS down 33, bonds down 20, commodities were down. Our clients didn't lose a dime on their principal guaranteed accounts. In fact, the first 3 buckets make money no matter what happens. And Mark, I think we're out of time on this segment, so I'll continue on the next side of this block.
Absolutely. So Brian and Arrin today are talking about the importance of having a plan. We know administrations change every 4 years, sometimes every 8 years, but you don't blow up your plan every time something like that happens. You put a plan in place so you don't panic when things change or get a little choppy. And that could be your health. That could be the markets. There could be a lot of things. The idea is having a plan and why it's so important. So now we don't panic. We can just kind of write it out because we've got the contingency in there already. And Brian and Arrin and the team at Decker Retirement here to help. 833-707-3030. Again, there is no cost for you to have a chat with the team. You got questions. Do we have enough? Are we going to be okay? Can we retire? Well, when can we retire? 833-707-3030. There's no cost. There's no obligation. There's no pressure. There's no judgment. Brian and Arrin and the team at Decker Retirement here to help. 833-707-3030. Brian and Arrin back with more right here on Safer Retirement Radio.
If you only think about taxes once a year, you're doing it wrong. To get the most out of your retirement nest egg, you shouldn't just file your taxes. You need to plan for them. Call Brian now to see what tax opportunities you could take advantage of. 833-707-3030. That's 833-707-3030.
Uncle Sam might need a loan soon from you. We have over $35 trillion in national debt. Where do you think the money to pay for that is going to come from? Taxes. Believe it or not, taxes are at historic lows right now. But how much longer will that last? A Roth IRA conversion might be a good option when planning for your retirement because you can pay lower taxes now and avoid potentially higher taxes later on. Brian Decker and the team at Decker Retirement Planning have seen taxes rise and fall. They know what options you have to potentially reduce the amount of taxes you pay in retirement. Call the team at Decker Retirement Planning and schedule your tax analysis today. 833-707-3030. That's 833-707-3030. Uncle Sam needs money. Don't let him take it from you. 833-707-3030. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor. Investing involves risk. Always consult with a qualified tax advisor before making any decisions regarding a Roth IRA conversion, as there may be additional tax considerations.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. You can always find out more about Brian and the team, find out about upcoming events, find out where the offices are, DeckerRetirementPlanning.com. I'm Mark Elliott, 833-707-3030. Brian and Arrin today talking about the importance of having a plan. So if the markets get wonky, your health gets wonky, or you lose a spouse, God forbid, you need to have a plan for what happens if this happens. Are we still going to be okay? Am I going to be okay? 833-707-3030. Brian, you were talking about really the idea behind why your clients have money in the market, but they also have some ladder your accounts as well. Continue.
Right. At the beginning of the show, we talked about the geopolitical events, the uncertainty that's out there for nuclear proliferation with Iran and North Korea, the tariffs, what kind of effect will they have? Will we have a world trade war? There's a lot of uncertainty right now. And so how are you protected if you're a retiree? So we draw from laddered principal guaranteed accounts, which Arrin is going to delve into in detail in just a minute. But I want to just hit the 4 key reasons that we draw retirement planning income from laddered principal guaranteed accounts. And the first one I mentioned is peace of mind. In 2022, Russia had invaded Ukraine. Markets didn't like it. S&P was down 19%. NASDAQ down 33%. Bonds that year were down 20%. Commodities across the board were down with the exception of energy. And a lot of clients lost a lot of money very quickly. That year, none of our laddered principal guaranteed accounts, which makes up about 75% of client portfolio, none of their money lost a dime. In fact, the first 3 buckets make money no matter what happens. And Arrin will go into detail on that. So the first of the 4 reasons is peace of mind. The second is we are using compound interest to our clients' advantage. We use the lowest earning accounts in bucket 1, and then bucket 2, 3, 4, 5 is where we're getting higher and higher returns. So we're using compound interest by drawing from the lowest earning accounts first, allowing the higher earning accounts to grow and compound during retirement. So in year 5, 6, 7, many times we have more total account portfolio value because we're drawing from the lower earning accounts, allowing the higher earning accounts to grow and compound more than offsetting what we paid out to the retiree client. The third reason is where we allow 15 to 20 years of portfolio income to be paid out, and that gives the risk bucket 15 or 20 years to grow and compound and reset the laddered principal guaranteed accounts so that we can replace the starting value. If you got $1.5 million that you're retiring with in 15 or 20 years, we might pay out that $1.5 million and then set aside 25% in risk to grow for 15 to 20 years and more than offset what's been paid out over that period. So it's a reset. It's a replenishment of the principal guaranteed accounts. And fourth and final, we are ultra conservative in the estimating of the performance. For example, bucket one, we show on the header earning 1% when in fact right now it's earning over 4. And bucket two is a 3-year account. We're showing at 3%, it's getting over 5. Bucket three is a 5-year account, principal guaranteed. We show it at 4%, it's getting close to 6. And then buckets 4 and 5 are 7 and 10-year principal guaranteed accounts. We show at 4%, and they're getting over twice that. So, Arrin, let me toss it back to you. Give any other details, big picture, and then let's delve into the details of what we put in there and why, and how clients really, when they see that quantitatively we dial their risk back to about 25%, they think, geez, I want more risk. And how many times in the first and second meetings, clients see that they're getting much more income than they ever thought possible per month. And they're doing that with 75% of their money taking zero risk.
Yeah, it's interesting to have those conversations because while we are a math-based firm, a lot of people have approached retirement from hey, I'm just going to save as much as possible, and at some point in time in the future, start taking withdrawals out of that and just hope I don't run out. There's been kind of like a theoretical approach so far, and they don't really have the concrete numbers to back up the decisions that they're hoping to make. And so that's one of the main ways we're able to help, is we're able to say, okay, look, here's the income streams that you have, your Social Security, your rental income, your pension, whatever else is supplying income. Here's the assets that you've saved up, your 401k, IRA, Roth accounts, brokerage accounts, whatever they may be, based off of our conservative assumptions, like you mentioned, Brian, the growth rates, longevity expectations, some of those other things. Here's the amount of income that you can spend to both maximally spend to really enjoy the hard work you've put into building up those assets, but also not put yourself in a position where you are possibly going to run out before you pass away. Nobody wants to plan to have all their assets used up by 85 and then live to 95. So again, we have a high priority on keeping you retired and making sure that that money lasts as long as you do, while allowing you to really enjoy it. Because nobody wants to save $5 million and then spend $50,000 a year. That's not really what those assets are all about. And so our goal is to be able to help you find that sweet spot where you're not overspending, you're not underspending, but you have kind of the Goldilocks scenario where you get to both enjoy it, maximally spending, but also making sure that the funds are going to last as long as you do. So one of the main ways we're able to keep that both conservative and consistent from an income standpoint is those principal guaranteed accounts, where we typically put 60 to 70% if you're trying to maximally spend on your plan. And within those accounts, like Brian mentioned, we have them laddered out. Usually there's 5 to 6 different principal guaranteed accounts that we have laddered out to make sure that the funds are protected, and also you're using them as income at the appropriate time. Now, within those, we want to make sure, like he said, that we are getting the highest rate of return, and also making sure that that's consistent for you. So the reason we put a lower amount in risk is to help you have that consistent income over time. Because if you have 50, 70, 100% of your assets at risk, you then are at risk to having your income year over year fluctuate based off of the market returns, where if it's in a good market cycle, probably works out in your favor for a little while, but eventually there are going to be corrections, market downturns, and then that's going to come back to haunt you. I'm sure the people that retired in January of 2000 or 2007, right before those market crashes happened, thought they were going to be okay too. And then they had to make some not so fun financial decisions of going back to work, selling their house, moving in with their kids. The way that we structure our plans and those types of protected vehicles prevent you from having any of those difficult things come up, because of the way that it's structured from the ground up to be conservative. So that's kind of the big picture things I would add. Anything else before we dive into some of the details of those accounts, Brian?
Yeah, talk about the difference and how we diversify fixed rate principal guaranteed and variable rate principal guaranteed.
So the first 3 accounts, which would be buckets 1, 2, and 3, are focused on more fixed rate products. Those are typically best for about a 5-year or less time period. When you get to longer durations, you get to 7 years, 10 years, 15 years, the fixed rate products are not the best option for both protecting the funds and being able to grow them at a good rate. So typically for the last 2 accounts, buckets 4 and 5, that typically last 10 to 15 years, We have these as still protected accounts, but they do have a variable rate of return that usually earns a higher average rate than you're going to get on something like a CD or any other kind of fixed rate investment. So these typically average 7 to 8%, but I've seen these make into the teens or high teens as far as returns. I've seen them hit zero. These do have a floor where you have protection on the downside. So if the market takes a nosedive, there is no loss or drawdown. And that rate of return you get is going to be variable and again, outperform those fixed rate investments that you're going to have. So we have the ability to use those for the longer time frames, like I mentioned, 7, 10, 15 years, because you're going to be taking income heavily from buckets 1, 2, and 3 at the beginning. You have the ability to have those longer dated accounts grow a little bit more with that variable rate of return for that time period.
So Brian and Arrin will continue the conversation in our next two segments as well, right here on Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. If you would like to sit down with the team, you were like, wow, I've never really thought of all of this like that. The importance of having a plan, getting some clarity and direction into how you're hoping to spend your retirement. And the idea is you think of the big Fortune 500 companies, they all have CFOs, right? Chief financial officers. In a way, Brian, Arrin, and the team at Decker Retirement can kind of be your own CFO to help you make the decisions you need to be making in retirement. It is about income, investment, taxes, healthcare, legacy planning, Social Security, Medicare decisions. There's a lot on your plate as a retiree. And we definitely want to make sure our money will last as long as we need it. That's for sure, no matter what happens. 833-707-3030 is the number to chat with the team at Decker Retirement. No cost to you whatsoever. Take advantage of this opportunity. Might be the most important phone call you make. 833-707-3030. Brian and Arrin back with more Safer Retirement Radio right after this.
Do you need help ensuring any remaining assets that you've worked so hard to create are distributed to your beneficiaries in the most tax-efficient manner? If you would like to talk or meet with Brian about your legacy planning, call 833-707-3030. Again, that's 833-707-3030.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
Glad you're with us today for Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Brian, Arrin, and the team at Decker Retirement here to help you figure out where you are. Can I retire? Do we have enough? Are we going to be okay if we retire? What happens if the markets go the wrong direction? What happens if we have a health issue? What happens then? How do we plan for all of this? There's so much on our shoulders when we get to retirement. It's different than your working years. You knew you had the paycheck coming in every 2 weeks or once a month or however you got paid at your job. Where's your income going to come from in retirement? You have to have a strategy, and how do you know that that check will be coming in for 30 years? Social Security, surely, but what else do you have? Brian and Arrin talking about all the factors when it comes to your retirement planning. 833-707-3030 is the number if you'd like to chat with them. No cost. 833-707-3030. All right, Brian, second half of the show. You've covered a ton of ground already. Where are you going for this final half?
Okay, we're going to put the rest of the pieces in place on the laddered principal guaranteed accounts, and then we're going to help retired clients that are listening know how they can help significantly lower their risk in a volatile, uncertain time on the risk portion of their portfolio. But Arrin, go ahead and finish out and give detail on the rest of the principal guaranteed accounts.
Yeah, so we've mentioned a couple times throughout the show here that we are a very math-based firm, and that kind of carries over to a number of different things that we do for the clients that we work with. One of them being the research process that we go through in order to give the recommendations for those specific principal guaranteed accounts, where These are things that we take very seriously, where again, our main goal is to help you have consistent income over time, protect those funds, have the comfort and the peace of mind that you're looking for. We put a lot of effort and do a lot of due diligence to get to the recommendations that we provide for those protected accounts. So the way that that works is we have a research team here in our back office that on a monthly basis goes out and does a pretty in-depth research process to find the best performing principal guaranteed accounts. Now, these do change on a frequent basis. There's going to be a lot of things that impact them: interest rates, geopolitical environments, any new financial vehicles that come to light. And so we want to make sure that we're always up to date on what the best performing vehicle for a specific circumstance or a specific bucket on the plan is going to be. So we do a lot of research behind those. Now, as far as what they are in each of those categories, they typically fall into these groups. So bucket one is going to be the income that you use at the beginning. So let's say you're currently retired, you need to pull income right away. This account is going to be money that you want to have 100% liquid and be an interest-bearing account. It always pains me to see people just pulling years worth of income from a checking or savings account where they're earning 0.01% interest on that money. And so we want to make sure that, again, it's liquid, but also gets an interest rate that's going to be equivalent to something that you would get from another protected account. So that's going to be bucket one. Buckets 2 and 3, these are the fixed rate investments. So there's going to be a wide range of vehicles or specific tools that fall into the fixed rate category. Our job here, again, is to do the research behind all of those, make sure that the issuing institution is financially stable, has a good credit rating, has a good reputation in the financial industry. And then once we get through those items, we look at, okay, which option is going to pay the highest rate of interest. So where these are fixed rate products, you know exactly the rate you're going to earn for that 3-year period for bucket 2 or the 5-year period for bucket 3. So those ones are going to be fixed rate products. Then when we get into buckets 4 and 5, these are the longer dated accounts. We typically have these into place for about 10 and 15 years respectively. And these are typically the variable rate of return instruments. So again, they have the protection on the downside so they cannot lose or have a negative return. Crucial when there are market corrections. And then the rate of return that they do earn is going to be variable, typically averages right now in between 7 and 8%. But those are going to earn maybe 15% in 1 year, maybe 1 or 2% in another. They'll fluctuate over time. But where we have a longer term time horizon at 10 and 15 years for these, they average a higher rate of return than you're going to get on any other fixed rate or savings, checking, money market type account that you could put those funds into. So overall, it's a phenomenal way to both protect the funds, grow them at a faster rate than having them sit in a checking or savings or other cash type account, and be able to use them as the income source for that first 15-year period. So anything you'd add to that, Brian, before we jump over and talk about how we can help protect with the risk funds?
No, let's talk about the risk funds. So when we talk about risk, I just want to point out that we are in a different period. The next 10 years will be different from the last 10 years. So there's been 4 times that the S&P 500 has ever traded above a market valuation of 30 times trailing earnings. 1929 and markets chopped and were flat for 17 years. 1964, markets chopped and were flat for 18 years. 1999, markets chopped and were flat for 14 years. Well, in November of 2021, we hit 32 times trailing earnings. If history repeats, and it's been 100% accurate on this, retirees, we are looking at 10 to 15 years where any passive investment strategy, buying and holding stocks, mutual funds, indexes, and ETFs will yield a 0 return. That is devastating for people in retirement to be staring down a future of 10 to 15 years of flat market returns. Well, here at Decker Retirement, we have an answer for that that's very, very important. We've dialed this in. We hope for the best, but we're planning for the worst. Is your advisor doing that? So when it comes to strategies that can make money in up markets and down markets, we've done our homework. We went to find what the biggest study ever done since 1950 was done by Jake O'Shaughnessy in his book, What Works on Wall Street, page 367, Appendix A. And he outlines the top performing strategies, and not the top 1, 2, or 3, but the top 15 are momentum, relative strength, and sector rotation strategies. These all work together. So imagine every stock is ranked 0 to 100 based on relative strength, which is a function of price appreciation and volume. Momentum has you buying the top relative strength stocks until something better comes along and you rotate into it. It is sector rotation. It is momentum and it's relative strength. So for example, in 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%. Had you been using momentum, you buy what is going up. There were several sectors of the market doing very well during that 3-year period where a lot of people were cut in half. Real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, and healthcare all made very good gains for those 3 years. And then markets bottomed in March of 03, and what exploded to the upside for the next 4.5 years were semiconductors, technology, small caps, emerging markets. They made huge gains. Now, rolling into 2008, momentum is absolute return focus, meaning that if nothing is going up, you are stopped into cash. And so you would have had a cash-heavy portfolio in 08 with the exception of treasury bonds. Treasury bonds were up 22% in 08. Now, we've gone even further on this to where we've split the strategies on momentum to where when the S&P is trading in an uptrend, trading above its 200-day moving average, we have 5 different momentum strategies in place to cherry pick the best parts of the market. Now, Vanguard puts out a statistic that 85% of money managers and mutual funds underperform the S&P every year. That's probably true. These momentum strategies since inception in 07, the S&P average annual since then is up 9. These are up 18. The reason they're up 2x, the S&P return, is because they're cherry picking the best parts of the S&P. They're not taking the dregs of the S&P, which drag the portfolio performance down. But then when markets cross the 200-day moving average, and by definition, we start a downtrend, rather than your advisor telling you to hold on and ride it out, which you can do in your 20s, 30s, 40s, and 50s, but you can't do that in retirement. You don't have the time and you're pulling money from a portfolio that's down. So what we do, just like in the NFL, pull the offensive team off the field. We put the defensive team on the field. These are 4 momentum strategies handpicked because they're very good at protecting capital in down markets, making money in down markets. So for example, in 2022, S&P was down 19, NASDAQ down 33, bonds down 20, commodities were down with the exception of energy, the frackers, the drillers, the pipelines, the natural gas and crude oil companies made 15 to 20% when most people lost 30 that year. So that's how the defensive strategies work. Since they started in 07, they have made money in every down markets together. When you look at all 4 strategies together, they've made money in every down market. That includes 2008, 2015, 2018, and 2022. So here at Decker Retirement Planning, we hope for the best, but we plan for the worst, and we are using momentum strategies to do well in up markets and protect capital in down markets so that they are designed to make money in up or down markets. Arrin, sorry about that. I took that whole topic. Anything else you would add to the two-sided models?
No, you do a great job describing that, Brian. The one other thing that I would just drill on to hit home is a lot of people have a recency bias when it comes to the market. And frankly, with the exception of 2022, the last 15 years have been pretty good, right? Like the 2008 market crash was a while ago. The 2000 tech crash was a while ago. And so with the exception of that recent dip in 2022, we've been a little spoiled from a general like index investing standpoint. And what you need to do is take a look at the longer time scale, even just the last 100 years, going back to the 1920s, 1930s, And to your point, there's been multiple time periods, not just one, but multiple, where you don't make any money for the course of a 10 or a 15-year period just passively investing in index funds. And so the question that I would have for our listeners is, if you have the majority of your portfolio invested in various index funds, S&P, NASDAQ, Dow Jones, and you don't make any positive returns for a 10 or 15-year period while pulling money out as income to live off of, are you going to be okay? And I'd be willing to bet that the answer to that question is no, that it's just going to exacerbate the losses, lead to problems down the road, causing you to have to decrease your spendable income, just the things that you're not going to want to do after you've stopped working, put all that hard work into building those assets up. And so that's exactly what the combination of these principal guaranteed accounts and our two-sided models, these risk strategies provide, is being able to weather those storms and help you still have the money that you've worked so hard to accumulate and really enjoy it through the rest of those retirement years.
And if you'd like to find out how that maybe pertains to you and your situation, you're like, wow, it'd be kind of neat to go through that process. See, maybe they can give me some great ideas. They probably can, but don't know for sure till you reach out. It's 833-707-3030. Again, this might be the most important phone call you make, and there's no cost for it whatsoever. Maybe you'll just get a pointer here or there from Brian or Arrin or the team at Decker Retirement. Maybe eventually you'll become a client. It's got to be a good fit for you, and it's got to be a good fit for them, because when we're talking about retirement planners and as clients, it's not for a week. It's for the rest of your life. So it's got to be a great fit for both sides. And Brian and the team and Arrin they're here to help if they can. 833-707-3030. 833-707-3030. Back with our final segment of today's Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Back right after this.
Crafting your legacy is like planting seeds for a future forest. Let's nurture your vision together. Speak with Brian and the team at Decker Retirement Planning at 833-707-3030 to ensure your legacy grows strong.
When you crash your car, you get it fixed. When your computer crashes, you get a new one. But what will you do if you've been saving in a 401k or an IRA and the market crashes? If you're in your 30s or 40s, you'll likely be just fine. But if you're in or near retirement, you could be in trouble. Brian Decker and his team at Decker Retirement Planning are here to help. They can run a risk analysis to see if you're too heavily invested in the market. Are you confident that a Wall Street crash won't wreck your retirement? If not, call 833-707-3030 today to schedule your risk analysis with Brian Decker and the team at Decker Retirement Planning. That's 833-707-3030. Crashes happen. Question is your retirement ready? Decker Retirement Planning, 833-707-3030. Investing involves risk, including the potential loss of principal. Investment advisory and insurance services offered through Decker Retirement Planning, Inc., a registered investment advisor.
You're listening to Safer Retirement Radio. If you like what you hear on today's show or have questions, drop by DeckerRetirementPlanning.com or call 833-707-3030 to talk to Brian.
Welcome back to Safer Retirement Radio with Brian J. Decker and Arrin Wray of Decker Retirement Planning. Again, you can go to the website, DeckerRetirementPlanning.com, to learn more. You can also go there if you'd like to do a little research about what's retirement all about. There's 12 different things you can download on the website, DeckerRetirementPlanning.com, under the heading of Safer Retirement Education. Brian's book on retirement, The Decker Approach, 3 Principles of Retirement book, Checklist Challenge, Sample Income Plan. That's just 4 of the 12 things you can download. They're really just there for your information. Grab what you want, learn more about what you want. It's all there just for you. And then if you have questions, call the team, 833-707-3030, 833-707-3030. All right, Brian, final segment. Where are you headed?
All right, let's just summarize that, we get a new administration, Mark and Arrin, every 4 years. You can't recreate a retirement plan every 4 years, or every time that North Korea lobs a new missile into the Japanese Ocean. So it's got to be a plan that is evergreen. And so when we have these different changes, what we do is we build the plan early on. Arrin, in that second meeting, clients are astounded of the income that their plan is able to produce. They never thought, 90+% of the time, it's a very happy meeting where they think, gosh, I'm so glad I didn't think I could get this much. So that's huge in that second meeting. Well, also in the second meeting, we optimize their Social Security. So every person's a little different with their ages. Some are married, some aren't. Some have marriages that are close in age, some aren't. And so we run a Social Security optimization report to make sure, since we're a math-based firm, that their Social Security, that they're drawing their Social Security in the most optimized way that they can receive the largest benefit possible mathematically. Now, Arrin, go in. We'll just take a minute on Social Security, but there's a couple other variables that play into Social Security. So talk about that for a minute.
Mm-hmm. Yeah. So just to kind of set the stage here, you can start Social Security withdrawals at age 62. In between 62 and what's called your full retirement age, which is usually around 67, in between 66 and 67, the benefit monthly for Social Security increases at 5% per year. So every year you delay it, it goes up 5%. Then in between your full retirement age and age 70, it increases at 8% per year and then maxes out at age 70. So you don't get any increase by delaying beyond that. Now that's for your own individual benefit if you had an earnings record where you're going to be eligible for Social Security. Now for married couples, that can differ where a lot of times one spouse is the primary breadwinner, the other one was focused on a homemaker role. And so you are, as the homemaker, eligible for what's called a spousal benefit, where you also get a Social Security income stream based off of your spouse's wages. So those are some of the things that can come into play when figuring out the optimized strategy. But as far as when would be best for you specifically to draw, there's a couple of things that come into consideration. The first is going to be how Social Security interacts with the rest of the income streams and the assets on your financial plan. What I mean by that is that we don't look at Social Security on an island by itself. We want to see how it interacts with the other income, maybe your rental income, your pension, and the other assets that you have that you will be withdrawing funds from for income, to make sure that all of those different puzzle pieces fit cohesively together. So that's the first thing that we look at. The second is that Social Security is, the timing of when you withdraw it is also somewhat of an educated guess on longevity. Because if you were to be one of the people that delayed until age 70 to start Social Security, you died at 72, that didn't really work out in your favor. But if you wait until 70 and you live to be 90 or 95, that worked out pretty well. So we want to make sure that based off of family history, any chronic or terminal illnesses you may have, some of those other things, that we're also bringing your health issues or non-issues, the longevity aspect of that into the plan. So we want to make sure, again, that it fits cohesively with the rest of your income streams, that we take any health considerations into the decision there, and then also make sure that you're optimizing it based off your specific situation, whether single, married, and so on.
So now let's get into, once we get into meeting 3, and by the way, we have 5 meetings. It doesn't take 2 meetings like a lot of our competition to create a retirement portfolio. Meeting 1 with our competition, how much you got. Number 2, how much can we get? No, we go into incredible detail. Meeting 1, we get to know you. We show you the difference between distribution planning and accumulation planning, what got you here. We talk in detail about advantages, disadvantages of each. And then meeting 2, like we were talking about today, we dial in the Social Security optimization report and version 1 of their plan. Meeting 3, we go into the stress test. So Arrin, start with that. I know we don't have time to get all the way through that, but the first 3 questions are, I think, more important than any of the others, but all of them are important. This is 40 years on a piece of paper of what has hurt people in retirement. We want to find out today if a person's portfolio or retirement plan has problems and we want to fix it today. We don't want to find out in their late 70s, early 80s if they have trouble.
Yeah, the overarching theme of the stress test is to, with our experience in this industry, make sure that your plan is ready for the future, both now and in the future. Like you said, Brian, you don't want to not talk about something that could possibly be an issue later on and have that just be a shock and surprise and derail things if that were to come to fruition. So the first thing that we hit when going through that stress test is about the annual income that you're looking for in retirement. Everybody has different goals from a spending perspective when they stop working and shift into retirement. Some people have a focus on spending as much as possible, really enjoying those funds, making the maximal use of those. Other people, the focus is more on a set level of income, and then the excess funds are given the responsibility of charitable giving or legacy or inheritance planning or any of a number of other resources where it's not just about them spending the money over the course of their lifetime. So part of what we dive into is how much income that you're looking for. Again, for 90% of the people that come through the door, the first version of the plan that we show them is going to be higher income-wise than they originally expected, which is a great thing. For those people that the income may be a little bit lower than they were hoping for or needing, we talk through a number of things to be able to get you to where you are. So again, with the experience that we have in this, there are a number of levers that we can pull or things that we can suggest that'll help to get you to where you want to be. Again, using that math-based approach so you know, hey, if I make X decision, here's the outcome of that decision. Here's what I'm going to have as my end goal there. So we talk through annual income that you're hoping for there. Anything else on that one before I jump to inflation, Brian?
Nope.
Okay. So the second one that we hit is around inflation protection. So luckily, inflation has come down a little bit the last year and a half. It was a little scary a couple years ago, but that's going to have peak and valley approaches over time. There may be a few years where inflation's 1 or 2%. There's going to be other years where it may be 5 or 7 or 10%. And we want to make sure that your plan has inflation protection mechanisms built in. So the first one that we use there is what's called a COLA, or a cost of living adjustment. We have a pretty good idea from history that inflation does happen over time. And so we want to build into your plan a planned annual increase to the income that you're taking, just to help with general inflationary pressures, general price increases that are bound to happen. The second is we consider the equity in your home. Now, this is not something that we build explicitly into the plan that you're planning on taking as regular income, but hard assets, such as your residence, are typically a good inflationary hedge. Whereas inflation kind of skyrockets, the value of those assets goes up. So if there were to be a need to tap that equity at some point in time in the future, you have that as kind of a safety net. Now, this could be something such as actually selling the house if it came to that, tapping the equity through a HELOC or a reverse mortgage, or through any of a number of other avenues. But it's really kind of a secondary safety net to help with crazy inflation down the road. The third thing kind of tied to that would be a downsize in your primary residence. Maybe you had a big family, raised them in that house. As you get older, you don't want as much maintenance or the yard work, so you downsize. And that typically leads to an additional injection of cash, which also helps with some of those inflationary pressures down the road. The fourth one is possible inheritance. Maybe your parents get older, pass away, give you a lump sum, or you have other relatives or people that have passed inheritance funds to you. That also helps with an infusion of cash. And the last one that we highlight is the conservative assumption, growth rate wise, that we put on our risk funds. So over time, so on our plan, we only assume that this is going to grow at a 6% rate of return per year, which is pretty low relative to the historical averages of those accounts. Brian talked about the two-sided models that we use. Those have averaged double digits over time, where even if you compound that over 5 or 10 years, that's a lot more money than the plan originally projected to help with, again, some of those inflationary pressures. Again, just to make sure that you can stay retired, we want to make sure that what's comfortable now, income-wise, is still comfortable 5, 10, 30 years down the road. So the last one I want to highlight there is the stock market crash. And we've hit this a couple times throughout the show today, where because of the principal guaranteed accounts that we put into place, the high percentage of your overall assets that we put into those protected vehicles, when there is another market crash, whether it be next year, 5 years, 10 years from now, you are not going to have to take a large income cut because of the protection that those vehicles offer. So again, we just want to drive the point home that things over the next 5 or 10 or 20 years are going to change. The news is going to put out a lot of scary articles. Presidents are going to change. Geopolitical circumstances are going to change. But the way that we build our financial plans helps you have that peace of mind, the comfort, the surety to be able to go out and do the things that you want to do in retirement. We put a lot of protection mechanisms into place to make sure that you aren't going to be one of those stories that you read on Facebook or Forbes or another news outlet where you had to sell your house, move in with your kids, do those not so fun financial things. So again, our main goal is to keep you retired, help you have the comfortable, enjoyable retirement that you're looking for.
So if you'd like to learn more about how all of because Brian and Arrin covered a lot of ground today, but it's really about the plan. It's about your plan. What do you need? What can put you in a better position? 833-707-3030, 833-707-3030. And I think you can just tell from the conversation, might be the most important phone call you make. Take advantage. 833-707-3030. Thanks for being with us today for Safer Retirement Radio. Brian and the team from Decker Retirement Planning back next week. Enjoy the rest of your weekend.
Security and insurance services offered by Decker Retirement Planning, a registered investment advisor with the SEC. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Decker Retirement Planning is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Decker Retirement Planning. This radio show is a paid placement.